Hi, this is John from the Cryptotunities team. Welcome to this week's Fireside Chat. This week, we dive into an area in trading and options that are critical to understand in light of our strategy using spread options. The team will also look at recent geopolitical news and give you our opinion on what it means for crypto. So stay tuned as we begin by looking at three principles that professional trading success hinges on: trend, probability, and logic. But how exactly do you apply these principles toward your trading strategy? Let's break it down step by step. First up, trend. It's crucial to identify and follow the prevailing trend in the market using trend price action move and corrective price action move analysis, TPAM, CPAM. Here's how. Start by examining the long-term charts to determine the overall trend direction. Look for patterns such as higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Now work out if the market is in a trend TPAM or a correction to the previous trend, CPAM. Once you've identified the trend, use technical indicators like moving averages or trend lines to confirm its strength and direction. Next, probability. Successful trading is all about playing the odds, but how do you calculate the probabilities inherent in each trade? Start by conducting thorough research and analysis. Study historical price data, market trends, and trading patterns to identify high-probability trade setups. Use tools like support and resistance levels, pivots, Fibonacci retracements, or candlestick patterns to pinpoint potential entry and exit points. Remember to consider risk management techniques like position sizing to control your downside risk. Now let's talk about logic. Trading should be approached with a rational and systematic mindset. Here's how to keep emotions in check and let logic guide your decisions. Develop a comprehensive trading plan that outlines your entry and exit criteria, risk tolerance, and profit targets. Stick to your plan religiously, even when faced with uncertainty or market volatility. Avoid impulsive decision-making by conducting thorough analysis and staying disciplined in your execution. And you will see results like we saw in our trading room over the last couple of weeks, playing out in your personal trading life. Now that we've covered the basics of trend, probability, and logic, let's address a common pitfall: trying to pursue multiple conflicting strategies simultaneously. This can lead to confusion and inconsistency in your trading. Instead, focus on mastering one clear objective at a time. Let's delve deeper into this crucial aspect of trading, focusing on one trade at a time. As you've experienced firsthand, trying to pursue multiple conflicting strategies or trades simultaneously only leads to confusion and inconsistency in your trading. It's like trying to juggle too many balls at once. Sooner or later, one of them is bound to drop. The key here is to concentrate all your efforts and resources on mastering one clear trade plan at a time. From analysis to execution and management to closure, every step should be meticulously planned and executed. And as we've seen in our recent trading sessions, this focused approach yields far better results than spreading yourself too thin. Picture it like this. You're laser-focused on one trade, like a skilled craftsman honing a masterpiece. You analyze the market conditions, identify the entry and exit points, and determine your risk management strategy with precision. Then, with unwavering discipline, you execute the trade according to your plan. Throughout the trade, you remain vigilant, managing it with care and precision. You stick to your predetermined parameters, resisting the urge to deviate from your plan. And when the time comes to close the trade, you do so confidently, knowing that every decision was made with logic and discipline. Remember what we discussed last week, though. Trading options and cash trading are not the same. In options, you determine your risk up front by position sizing, and you leave the option to do its job. What you focus on is exiting for profit, scaling out, or being content to let the option simply expire worthless. But you must understand this when using spread options, like we do in our trading. If your strategy is to scale out for profit or allow the option to expire worthless, there are several ways to manage assignment risk while still sticking to your plan. 1. Monitor your positions closely. Keep a close eye on your option positions, especially as expiration dates approach. By staying vigilant, you can react quickly to any changes in market conditions or potential assignment risks. 2. Adjust your position size. Consider reducing the size of your option positions to minimize potential losses in the event of assignment. Scaling down your position size can help mitigate the impact of assignment risk on your overall portfolio. 3. Roll your options. If one leg of your spread is at risk of assignment, consider rolling the option to a later expiration date or a different strike price. This allows you to maintain exposure to the underlying asset while potentially reducing the likelihood of assignment. 4. Close out the position early. If you're concerned about assignment risk and the option is trading at a loss, consider closing out the position early to limit potential losses. While this may result in a loss, it can also help protect your capital and avoid the risk of assignment. 5. Stick to your trading plan. Remember that assignment risk is a normal part of options trading, and it's important to stick to your trading plan regardless of short-term fluctuations in the market. If you've done your due diligence and analysis, trust in your strategy and remain disciplined in your approach. Please note, using options with 0 days to expiration, 0 DTE, or options that expire the next day for day trades can be a high-risk strategy due to their short-term nature and rapid decay in value. Please consider this for trading these short-term options. 1. Increased volatility. Options with 0 or 1 day to expiration can experience significant price swings in response to even small movements in the underlying asset. This heightened volatility can result in both rapid gains and losses, so it's crucial to be prepared for sharp price movements. 2. Time decay. As options approach expiration, their time value decreases rapidly, especially in the final hours of trading. This time decay accelerates the closer the option gets to expiration. As a result, holding options until expiration can result in significant losses if the underlying asset doesn't move in the desired direction quickly. 3. Liquidity. Short-term options may have lower liquidity compared to longer-dated options, which can result in wider bid-ask spreads and increased slippage when entering and exiting positions. It's essential to trade options with sufficient liquidity to minimize transaction costs and ensure timely execution. 4. Risk of assignment. When trading options that expire the next day, there's a risk of early assignment if the option is in the money at expiration. This can result in unexpected exposure to the underlying asset, which may not align with your trading strategy. 5. Risk management. Given the high-risk nature of trading short-term options, it's crucial to implement strict risk management measures. This includes setting stop-loss orders to limit potential losses, sizing positions appropriately to avoid overexposure, and maintaining discipline in sticking to your trading plan. 6. Consider alternatives. Instead of trading options with 0 or 1 day to expiration, consider using options with slightly longer durations, such as weekly options or options with a few days to expiration. These options still offer the potential for short-term gains, but may have slightly lower risk due to their longer time horizon. The beauty of this approach lies in its simplicity and effectiveness. By focusing on one trade at a time, you eliminate distractions and maintain clarity of purpose. It's a wash, rinse, repeat process. You master one trade, close it, learn from the experience, and then move on to the next one. So as we continue our journey together in the world of trading, remember this golden rule. Focus on one trade at a time, well planned and executed until closure. By following these step-by-step guidelines, you can incorporate the principles of trend, probability, and logic into your trading strategy and increase your chances of achieving consistent profitability in the dynamic world of professional trading. So go ahead and apply these practical steps to your trading journey. With dedication, discipline, and a clear strategy, you can take your trading to the next level and achieve your financial goals. Up next, Crypto News with Jane.
Thanks, John. Bitcoin's recent 9% crash, spurred by geopolitical tensions, sent ripples of concern throughout the crypto market. Despite the abrupt downturn, analysts like Taz maintain a cautious optimism, drawing parallels to historical patterns where such sell-offs have proven ephemeral. Preceding the geopolitical turmoil, the market had already weathered a tumultuous week, characterized by widespread losses across stocks and cryptocurrencies. Notably, Bitcoin and Ethereum experienced relatively modest declines of 2% and 4%, respectively, whereas many altcoins suffered substantial losses. This market turbulence reflects a familiar narrative seen in previous pre-halving periods, where cryptocurrencies typically surge in the months leading up to a halving event before experiencing a sharp decline shortly beforehand. While geopolitical tensions may continue to exert pressure on the market, indicators of inflation have shown a decrease, providing a degree of stability amidst uncertainty. In terms of technical analysis, Bitcoin's bounce off its 100-day moving average is seen as a promising sign. TASE is waiting for confirmation of this bounce and will closely monitor Bitcoin's price action, particularly its movement towards the $70,000 threshold. In conclusion, while market sentiment remains cautious, the current downturn presents a potential buying opportunity for savvy investors. Developments within various cryptocurrency projects underscore ongoing innovation and growth within the crypto ecosystem. Active applications on Akash network have surged past 5,000, marking significant growth for the network. Amid escalating global tensions, Michael Saylor's optimism about Bitcoin's resilience as a hedge against chaos contrasts with market realities. Bitcoin ETF issuers have significantly increased their holdings to 4.27% of the total BTC supply, thanks to the launch of spot Bitcoin ETFs. It's interesting to note that the United States, United Kingdom, and Germany are among the top countries holding cryptocurrencies at the government level, according to data from Arkham Intelligence. Analysts and economists are increasingly delaying their predictions for when the U.S. Federal Reserve will cut the benchmark interest rate, with uncertainty mounting due to persistent inflation concerns. This is Jane signing off. Please don't forget, Taz will be fielding another action-packed trading week in the trading room Tuesday to Thursday at 8:30 a.m. Eastern Time to 11:30 a.m. Don't miss it. We look forward to seeing you. Have a great week. Bye for now from the Cryptotunities team.